taking this forward, we can do a cost volume profit analysis. A cost volume profit analysis is tries to give us an understanding about to get it is known as CVP analysis as well. So cost volume, the volume says the volume of production, and profit analysis, also known as CVP analysis or CVP analysis, right? So this cost volume profit analysis says that given my desired output, given the unit selling price, given the unit fixed cost, unit variable cost, and eventually the total cost, what can be my output to get a certain level of profit, or what can be my output to get to be on the break-even point where my total revenue meets the total cost. That is primarily when I start a business, I know, or when I start a production, or when I start to deliver my services, I know that at the very beginning I may not get profit, or I may incur losses. But it is important to learn that where my profit and cost are meeting each other. That means I am on a break-even point, and I also know that after that I am going to make positive profit. My total revenue will overcome my total cost. So this is how many units of output I must produce, I must sell, what should be the cost in terms of several administrative parts, advertisement costs, and so on and so forth. If I change my technology, how much I gain and all. But basically this cost volume profit analysis just requires few basic inputs, that the selling price, the number of units I desire to produce, or I will produce, or I am producing, the fixed cost, the variable cost, and that is all. So as we know, the break-even point is where the total revenue and total cost matches, and in a production firm I can calculate my profit. I can calculate my profit as, what is profit? Total revenue minus total cost. So I can calculate my profit given by my total revenue minus variable cost minus fixed cost, isn't it? Or I can keep this variable cost and fixed cost together, that is my total cost. Total revenue minus total cost is my profit. And in break-even point, this profit on break-even point, what happens? My profit is equal 0. Or if I want, say, 10,000 rupees of profit, my profit becomes 10,000. If I want to attain the break-even point, this becomes 0. So let us understand how we can get my profit or my break-even point. Just for a simple example, take a simple example that say my price per unit of sales per unit sales, say this is rupees 500. Yes, variable cost is rupees 300. My fixed cost is rupees 80,000. Yes, this is my all the information given. They say that what will be your profit, or how much you want to produce if I am in a break-even point. So my profit is 0 on a break-even point. So on a break-even point, I must produce, to be on a break-even point, I must produce that amount which will take my profit to 0, and my profit becomes 0 when my total revenue, which is 500 multiplied by Q, I don't know what is Q, I am going to find Q, minus total variable cost is 300 multiplied by Q. 1 unit variable cost is 300 rupees, and for Q number of production, my variable cost will be 300 multiplied by Q minus 80,000. This is my fixed cost. This is not associated with production, right? So whatever the production is, Q 0, 1, 2, 3, 4, 5,000, it is remaining 80,000, and this all should equate to 0 because I am trying to find my break-even point. So 500 Q minus 300 Q will give me 200 Q minus 80,000 equals 0. So I can get 80,000 that side on my right hand side. So 200 Q is equal to 80,000, which eventually give me Q equals 80,000 by 200, which is 400. So I get my quantity, which is 400. So to attain a break even point, I must produce at least 400 units of product, 400 units. There is a concept of contribution margin per unit when we do break even point, when we do cost volume profit analysis. So contribution margin per unit is nothing but the per unit difference between the per unit selling price minus per unit variable cost. So this difference is known as contribution margin, So now we take few assumptions while we do cost volume profit analysis. Which are those assumptions? I'll just try to write them down. So number one assumption is changes in the level of revenue. So changes in revenue and costs arise only because of units, or only because of number of units produced and sold. So that means my revenue and cost will only depend upon Q, that is the total amount of production I am, or the total amount of production I am manufacturing or I am selling. The second is total costs can be divided into fixed cost and variable cost. So total cost can be divided into fixed cost and variable cost. Now fixed cost is fixed irrespective of the output of production, whereas variable cost is will change with respect to the amount of production or the level of output. The third is when graphed, both total revenue and total cost curves will be linear. So if I have my total revenue curve, when I have my total revenue curve, which we saw it's to be a straight line, and I had my total cost curve which is like this, no, it will no more be like this. My total cost curve will will be something like this, will not be like this anymore, So it will be something like a straight line. So this is my total revenue, this is my total cost. So this, the green one is my total cost, and then the blue one is my total revenue curve. Yeah, so when graphed, they will take a straight line approach. The next one is we have information about the unit selling price, the fixed cost and the variable cost. We have information, are all known and constant. They are not changing while I am doing this CVP analysis, so they will remain constant. The fifth is that when we are talking about the revenue and cost, they can be added and compared without taking into account the time value of money. So when I am doing my CVP, I don't take into account my time value of money. Is not taken into account. That means whenever I am estimating the revenue and I am estimating the cost and I am doing a cost volume profit analysis to find a particular level of output to achieve the break even point or to achieve a certain level of profit, I don't consider that if there is any time lapse or so there is no cost associated with the time. Therefore, we can, whatever we talk about revenue, we are talking in terms of, we can also call it operating income, operating income, because that is the difference between this total revenue and total cost. The difference between the total revenue from the operations and total cost from the production of goods and services, as well as this operating cost. So total revenue from the operations and total cost from the production of goods and services, as well as this operational cost or other administrative costs and all, which are essential for this production process. Here we are not considering tax. Tax is not considered. Income tax, yeah, is not considered. Fine. But when we are talking about net income, so this is my operating income minus income taxes. Yes? Okay. We will do a small problem, just to show how this thing works. Say, assume a medicine shop that purchases medicine at a rate of rupees 32. So a medicine shop purchase medicines at the rate rupees 32, yeah, from a manufacturer. Other variable costs are rupees 10. Costs is rupees 10 per unit. So what is my total variable cost? My total variable cost here 32 plus 10 is 42, right? Because 32 is to get the medicines, purchase the medicines. Each medicine will cost me 32 rupees plus other variable costs pertaining, maybe it's a transportation cost, billing cost and all these things, ordering cost, inventory cost is rupees 10. So the total variable cost is rupees 42. And the manufacturer allows the shop to return the medicines and receive a full rupees 32 refund as refund after a year or within 1 year, not after a year, within 1 year, within a year. Yes, the average selling price is rupees 70. So the selling price per unit average, yeah, is rupees 70. And total fixed cost is rupees 84,000. Let's see what happens. The question is, how much revenue will the business or will the medicine shop receive if 2500 units are sold. Here I know my quantity, I don't know my profit. So that's what are being asked. It can be profit, it can be loss, you know. So the total revenue is nothing but 70 multiplied by 2500, which is nothing but 175,000 or 1,75,000. Yes, so the variable cost, total variable cost is, now I know 32 plus 10, 42 was the total variable cost. So 42 multiplied by 2500, which amounts to 105,000. And then my total profit will be total revenue minus total variable cost minus total fixed cost, which is 14,000. So this is how I can estimate my cost. Now what is my contribution? I mean I can estimate my profit. Yeah. So what is my contribution margin per unit? As I mentioned, this is the difference between the per unit selling cost and per unit variable cost. So per unit selling cost is 70, per unit variable cost is 42. So my marginal cost per unit is rupees 28. So this is contribution, not marginal cost, sorry, this is contribution margin per unit, which is the difference between the selling price and then the variable cost. If I want to know that total contribution margin, if I want to know total contribution margin, then I just multiply my contribution margin per unit, which is rupees 28, multiplied by 2500, because that is my total sales or total production, total sales in this example. So rupees 70,000 is my total contribution margin, and the contribution margin percentage which is also known as the contribution margin ratio, is estimated as the ratio between the contribution margin per unit and then the selling price. So this is the ratio between contribution margin per unit, which is rupees 28, and the per unit selling price. So 28 by 70, which can be 0.40 or 40% is the contribution margin percentage over the selling price. Therefore, we can have an idea about the contribution margin, the break-even point, the profit level at various points. We can also estimate our break-even point. We can also estimate our break-even point in terms of the contribution margin approach. So we can estimate our break-even point by contribution margin, following contribution margin approach. Through the ratio between fixed expenses or fixed cost, by the ratio between fixed cost and unit cost margin. Yeah, so unit cost margin is nothing but, I'm sorry, I should have mentioned, it is nothing but the contribution margin per unit. Unit cost is nothing but the contribution margin per unit. So in my previous example, if my the fixed cost 84,000 and my contribution margin is rupees 28, so I can estimate my break-even point as 84,000 by 28, which is 3,000 as my break-even point. Yeah. So this is how we can estimate my my break-even point. And I can also estimate the level of profit if amount of production given the level of profit. If I have as the similar to fixed cost plus the level of profit or the target profit divided by the contribution margin per unit. Divided by the contribution margin per unit, and then we will have an idea that how many units I need to sell, or output needs to be, or units or outputs needs to be sold or manufactured to attain the target profit. That means it can also give us an idea, target profit by pi. It can also give me the idea, if I am starting my hospital, that how many patients I need to treat, or in IPD or in OPD or in together, to get my break-even point or to attain a certain level of output, and or how many beds I need to keep when I will try to attain a certain level of output or production. Thank you.